Hi, I'm Tim Kelley from the Montgomery Fund, and welcome to this week's Video Insight. Today I want to talk about business quality, which is one of the first things we look for in any business we invest in. We think of quality as the ability of a business to earn outsized economic returns a long way into the future, which means that every incremental dollar of capital invested in the business will deliver a lot more than $1 of value for shareholders. Over the long run, businesses that have this ability can deliver exceptional returns, and it's worth making a bit of an effort to find them. It's also not that hard to identify them. We study quality in a fair bit of detail in our investment process, but in reality, if you can answer a couple of fairly simple questions about the business, you can pretty quickly get a sense of whether it is likely to have the ability to earn sustained excess returns by avoiding price competition. Here are two questions that you might find helpful. These aren't the only things to look at, but they're a pretty good start. Firstly, how hard would it be for others to provide the exact same product or service that this company provides? For example, if you're looking at a mining company, there will usually be a number of other companies who can deliver the exact same commodity. That's a problem because if the product or service is identical, the only way to compete may be by lowering prices, and lower prices very quickly destroy excess returns. Even if a business is the only one of its kind and is able to make good returns because there's no competition, if it's easy for others to do exactly what that business does, then sooner or later it's likely that they will. Secondly, how hard is it for customers to switch to a competitor? High switching costs can make it easier for a company to retain customers and avoid price competition. And a good example of this might be banking services, where the process of switching all of your banking arrangements from one bank to another is tiresome. And that means that people are reluctant to do it. A bank that competes by lowering its prices may find that it earns less revenue from its existing customers, but doesn't necessarily gain a lot of new customers because they need a good reason to make that switch. In that sort of market, companies tend to be a bit less aggressive on pricing, and that can only help long-term returns. Of course, these two questions are only a small part of the overall quality picture, and they can't tell you the whole story. However, they are among the more important ones, and they can help you to pretty quickly get a sense for whether a business is likely to have the right attributes and therefore allow you to focus your attention on the best opportunities. Businesses that are truly high quality tend to be good investments to own over the long run, so it can be well worth the effort at the start to find them. Happy hunting. We'll be back with more next week, and you can follow us in the meantime on Facebook and Twitter.